The Bank of England's latest policy decision due out any second now, and as expected, no change on the interest rate, held at a rock bottom record low 0.5%, and the bond buying QE programme also holding steady at £375 billion. Well, let's get out now to Azad Zangana. He's European economist at Schroders. Azad, no change on rates or QE as expected. Does this make more easing in November a certainty?
Well, I think it's very likely that they will decide to continue with at least their bond buying programme into November. Although I don't think that they're yet ready to cut interest rates any further. They're clearly trying to assess what the funding for lending scheme would have done for economic growth, especially lending growth. But it's too early to tell at this point in time.
OK, and just in the last couple of minutes, the reaction in the markets to that. Cable up about 10 ticks or so to $1.61.5. The FTSE off a couple of points down to 5832, and the 10-year yield holding steady at 1.68%, so not much reaction. Given your outlook for more easing, and given what we know about the UK economy still mired in recession, what's your outlook for sterling for Q4?
Well, I think for Q4 it'll probably hold fairly steady. I think sterling is really being driven by safe haven flows or a need for money to find an alternative to the euro at the moment. So if we get some positive news on euro developments for Spain, for example, whether they finally agree on a bailout, then we could see sterling weaken a little bit as those flows reverse. But if that doesn't come to play, then I think sterling holds steady for the fourth quarter. And
talking of Spain, we had a pretty decent auction from Madrid of 2, 3 and 5 year paper. Yet the Spanish central bank governor coming out saying the outlook for next year is 3 times as bad as the government forecasts. How bad does it have to get for Spain before they make that formal request for aid?
Well, clearly the market isn't putting enough pressure on Rajoy at the moment to seek that bailout. But then again, the market clearly expects a bailout to be forthcoming. If the ECB was to withdraw the offer of bond buying, and if that ESM deal of recapitalizing the Spanish banks was to disappear, I can quickly see Spanish bond yields rising. And so it's difficult to say when it will eventually happen or how much more pressure is needed, because clearly under the expectations that help will be provided, yields are not providing enough pressure for the Spanish governments at the moment.
And it's the yield that's quite critical here, because Rajoy himself said we will seek aid, but only when yields are too high for too long. And as we speak, we're still quite comfortably below 6%.
No, that's right. So there's no immediate need for them to ask for help. But I think even Rajoy will admit that he knows that the system at the moment is expecting help. So without that help, yields would rise. I do think, however, that what we're seeing is a negotiation behind the scenes between Spain, Germany, Finland, and everybody else really within Europe. And I think that's the key reason why there's been a delay to this bailout coming through.
OK, we've just had the Bank of England. Of course, next is the European Central Bank. All eyes again on Mario Draghi. What meat can he add to the bond buying bones, if you like?
Well, there's very little left he can do. He's effectively set out the outright monetary transactions system. And really, it's now down for politicians to agree on the conditionality for Spain to sign up to that conditionality, which would then trigger the ECB's bond buying. But until that happens, the ECB has effectively tied its own hands.
OK, Azad, thank you very much. That was Azad Zangana at Schroders. That's all from us for now, but check in again with us later today for full analysis of today's ECB policy decision and news conference. And join us each weekday for Market Pulse, your snapshot of what's moving on markets and why. I'm Jamie McGeever. This is Reuters.